Today, I want to share something with you that a mentor once told me that completely changed the way I looked at investing, especially for retirement. When I first started, like most, I thought I was smarter than the markets. I thought I could time markets. Eventually, he pulled me aside and said, "Listen, Devlin, I've never met an investor, even the smartest trader, that could consistently time markets right." And then he said something that really stuck with me. He said, "It's not about timing the market. It's about time in the market. That's what builds real wealth." And then he asked me, "Where do you see prices going in 1, 3, 5, 10 years? Because when you understand the trend, the day-to-day noise becomes irrelevant." Before we begin, remember to like this video and subscribe for more economic updates. Here's a trend we can't ignore. The dollar is structurally losing purchasing power faster and more permanently than at any point in our lifetime. The forces are already at work. U.S. debt is at $38 trillion. I can't believe I'm even saying that. And it's growing by billions every day. Interest payments are now the fastest growing federal expense, already surpassing defense and Medicare. Foreign governments are ditching treasuries and buying gold. Government shutdowns are signaling systemic stress, including substantial impacts on the U.S. industrial base. Global sanctions and trade fragmentation are pushing finance away from the dollar. Tariffs are elevating domestic prices. Social Security's trust fund is projected to cover only 77% of future benefits. Inflation is sitting above the Fed's target even while upcoming rate cuts are expected. And for the first time since 1996, gold now surpasses treasuries in foreign central bank holdings. These are not temporary issues. They're structural economics in motion. And when structural economics move, math wins. It's obvious that the dollar is losing purchasing power. Grocery prices are up, utilities cost more, and retirement dollars are stretched even thinner. So the real question is very simple. If the dollar continues to lose value over the next 1, 3, 5, 10 years, what will happen to the price of gold? In 2001, gold averaged about $271 per ounce. At the time of this recording, it trades above $4,000 per ounce. That means gold has increased by more than 1,300% since 2001, while the dollar has lost approximately 40 to 50% of its purchasing power over the same period. Very few assets hold up like that, especially for retirement portfolios. Pullbacks, they're part of the story. Strong bull markets don't move up in a straight line. They pause, they reset, they consolidate, but the trend doesn't change, it amplifies. There's nothing in the fundamentals supporting higher gold prices that is reversed. If anything, they're gathering force. Financial advisors always tell you don't panic during stock pullbacks because over time, markets go up. Well, the same is true with gold and silver and then some, except without Wall Street fees eating into your returns. And right now, the short-term and long-term view matter more than ever. Because the real question isn't, where are prices today? It's, where do you believe the dollar will be over the next 1, 3, 5, 10 years? Because if you believe the dollar will get weaker, then by definition, it will take more dollars to buy the same ounce of gold or silver. If the dollar didn't already have enough problems, the Fed is expected to cut rates again through 2026 and print more dollars with quantitative easing. Quantitative easing, or QE, simply means the Fed creates new money to buy bonds and other assets. That floods the system with liquidity, pushes interest rates down, and weakens the dollar's buying power. More dollars, less value. That's why gold, and especially silver, tend to rise when QE ramps up. Silver structural supply deficits have persisted for years. Industrial demand for silver is breaking records, including solar, electric vehicles, and infrastructure. Inventories of silver are at multi-decade lows, and silver remains historically undervalued compared to gold. So what's next for gold? Do you want to sit on the sideline, watch, guess, and try to time it? Or do you want to be in it and let time work for you? Because time pays rewards to those who own assets that endure. And as my mentor told me long ago, time doesn't wait, but pays those who stay.
Sign up for your one-on-one web conference with Augusta Precious Metals today. No commissions, no pressure, just education. Click the link in the description to learn more.